Moon Gang.
Hello, hello, hello. Get ready for some craziness in the market because the Fed's decision for the FOMC, the Federal Open Market Committee, is going to be live in a couple minutes. We're looking at 7 minutes. 7 minutes, folks. And boy, oh boys, there are going to be some crazy volatility. Let's get right into it. Let's see what in the world we need to be talking about. So overall, we've seen a massive bounce in the markets. Around 11:30, it pulled a hardcore U-turn. And even though if you guys were watching the morning stream, you know I got margin call down here. If I held, we would have hit that profit, which does it piss me off? More than you could ever possibly imagine. So I have the SPY, the tech sector, we have volatility, and we also have Bitcoin up on the screen. So there's going to be massive swings starting at 2, and then they will continue at 2:30 when Jerome Powell starts speaking live. 2 p.m. we get the results. Jerome Powell, the chairman of the Fed, starts speaking at 2:30. Now, most people are looking for a 0.5% interest rate increase. So that's a number to keep in mind. But the big thing is, and we're going to get more of this really from when Jerome Powell starts talking, according to the minutes, the Fed started getting rid of those bonds to the tune of $95 billion a month. So we're listening to what's referred to as the balance sheet normalization, the balance sheet runoff, whatever you want to call it. That's really what we need to be listening to, because if they want to do it more aggressively, more rapidly, at a higher rate, that's more hawkish. Not good for markets, not good for equities, not good for crypto. On the flip side, if they do it a less aggressive, that's a bit more dovish, well, that's going to end up being more bullish for the overall market. So we're listening for the interest rate increase. What's that number? Most people are saying 0.5%. That's really what's being priced in right now. But more than that, it's all about balance sheet normalization. It's all about balance sheet runoff. So let's get ready, because we now have about 5 minutes. And what I want to remind you of is, hey, we have a little bit of a game going on right now. So it is pinned to the top of chat. If you just go to mattkohrs.locals.com, come to this one, the first one, I pinned it, new competition. Post your prediction for the high value of the S&P 500 today. Right now, what are we sitting at? A high of 418.47. You can post up until, really, we're going to say 2:30 is the cutoff time. You have a half hour, 2:30 p.m. today, May 4th. Any votes past 2:30 do not count. What you need to do, head over here. It's pinned to the top of chat. It's in the description. If you don't have an account yet, the code is FOMC. There's about 20 more free codes left over right now. FOMC. All you have to do is make sure that you're on monthly, not annual. Go over to the website, click, try to sign up. It's going to be free. Like, that's the coupon code for 100% free. FOMC, put your guess here, and whoever's closest, you're going to get a year free. So it's just a free competition. And I don't know, I always find a little bit more enjoy in this just because of how absolutely wild things can get. Let's get rocking. I'm excited. Is this actually pinned, though? I thought I pinned it. Let me reload it just to make sure that it is pinned. All right. I think we're rocking. I think we are rocking. For some reason, it's not pinned. All right. I'll pin it now. All right. There it is. Message pinned. I'm told that it's pinned, and it's about to go wild. So we could do a little bit. Oh, I need a poll from you. Okay. Tell me. So I saw some people were talking about TradeStation, saying that they weren't allowing trading. That is 100% wrong. I don't know where people are getting that, but it is more along the lines of they are making you have full margin. They didn't stop trading like whatsoever. They just said you have to have full margin, which I think is pretty fair in a high volatility scenario. That's what good brokers do. They properly check for their margin so we don't have like another Robinhood circa January 2021 scenario. I saw some of these things making their rounds on, I think Twitter was the main space of like, hey, we think that they stopped trading. They didn't stop trading. That's just literally not how it worked. They made it so you had to have full margin, which means at this point in time, I can only trade one, but I'm going to do whatever you guys tell me to do. Are we going red? Are we going green? and we're going to try to make 500 buckaroos. 500 buckaroos. Let's get going. What time do we have? Okay, we have exactly 2 minutes left, which means, right? Are you guys voting? Make sure everyone votes. We need the most votes possible. Most votes possible. Matt, can we get a Twitch video as well? It's running on Rumble and YouTube right now. We only do Twitch in the morning. And I'm really not liking what's going on with Twitch lately. And what I mean by that is, like, I heard recently that they're going to start giving less to their creators. It doesn't really impact me because I'm not that big on Twitch. I'm really not big at all on Twitch. But Amazon's making really weird decisions with it. Really weird decisions with it. All right. What time? Is it almost 1:58? We're getting close, team. We are getting close. Okay, we have... Oh, you guys pinned it halfway. End poll. Which one won? Which one won? End poll. 415 people. Slightly edged out by red. Slightly, which means we're going to... You heard it. All right, we sold. We're putting in the profit target right away for 500. We are good to go. Good to go. This is going to get crazy. All right, so I have the trade in. The results are going to be here momentarily.
Financial conditions might not be tight enough to control inflation. I agree with what David's saying. I think that plenty of things are going to slow down, but will it happen fast enough for the Fed's liking?
Financial conditions not tight enough, Jim?
Oh, golly.
I don't think so.
Golly.
Based on where I see credit spreads right now, credit spreads have been hanging
Here's
in
the
pretty
trade.
nicely.
You guys told me to go short. We're pretty much break even right now, looking for 4,177 basically to take the $500
to come down. So that's in the next couple of years. So I would argue right now.
All right,
yes,
it's 2 p.m. What are the results? What are the results?
And rates have gone up, but we're not really seeing enough of a slowdown, at least by my calculations, to get to 2% inflation.
Is it going bullish? Remember, there is the old adage of the first move typically the wrong one. What is it? It's just this is not it yet.
Steve Leisman for the news. Steve.
Federal Reserve raising the target rate for the federal funds rate.
Just hit the 500.
50 basis points to a new target
that was
range
expected.
Of 75
All right.
basis points to
all expected.
1 percentage point. The Federal Reserve increasing, says ongoing increases will be appropriate. The Fed will begin to reduce the balance sheet on June 1. It will ramp up the balance sheet reduction over time. It's going to begin with $47.5 billion in balance sheet reduction through August. And then after that, 3 months, it's going to reduce the balance sheet to allow the runoff of...
Yo, CNBC, what are you doing to us? CNBC, why are you fucking up right now? That's not good. Not a good look, CNBC.
The Russian invasion of Ukraine
start to slow down.
Ramp up the balance sheet reduction over time. It's going to begin with $47.5 billion in balance sheet reduction through August, and then after that 3-month period, it's going to reduce the balance sheet to allow the runoff of $95 billion a month as expected, and that'll happen beginning in September. That'll be a total of $60 billion in treasuries running off the balance sheet every month. $35 billion in mortgages. The Federal Reserve says household and business spending remains strong. Job gains.
Dude, they're really messing it up.
Robust. The Russian invasion of Ukraine likely puts upward pressure on inflation and weighs on economic activity. A very quick analysis, guys. There's one sentence in here that was a little more dovish than I expected, and a lot of other observers thought there'd be a line in here about the Fed moving expeditiously towards neutral. It doesn't say that. It just says anticipates ongoing increases will be appropriate. Doesn't say how much. We're going to have to leave that for Fed Chair Jay Powell, and whether or not he'll put some character on the pace and amount of tightening to
Powell.
come from the Federal Reserve. But as expected, 50 basis points and balance sheet runoff ramping up to $95 billion a month. Kelly?
Steve, let's highlight two key things here as we're watching a knee-jerk dovish reaction to the statement. We see yields dropping about 5 basis points on the 10-year to 295 and equities moving higher somewhat. The Dow is up 250. It seems like you said they didn't use the word expeditious. Also, why are they doing half the expected pace of quantitative tightening for the first 3 months?
That's pretty dovish.
Oh, so no, we expected that. We actually began to survey that, Kelly, back several months ago.
Oh, a survey.
In the Fed survey that the Federal Reserve would ramp up to the $95 billion. They've done that before. That was, I think, fairly well expected. I apologize for not mentioning it in the lead up to this, but they're going to do that for 3 months. They want the market to adjust to this. Then they'll get to $95 billion.
So you think this is, what do you think then, Steve, are the dovish surprises from the statement? No dissenters.
Just the one comment here. I saw a bunch of people, and because Powell went forward and said we're going to move expeditiously back to neutral, people thought that was going to be the new sort of buzz phrase that told us 50s were in and around or possibly coming
Fed Reserve
for the
half percentage
statement.
point,
But
the
that
biggest
was
hike
not
in 2
adopted
decades to
in the
fight
actual
inflation.
language here. We'll see if Powell uses it again expeditiously to neutral to put numbers around that, Kelly. The way people understood that is
off of
50 basis point
417.75
hikes to 2.25, 2.5. They didn't say that. I'm not going to go overboard here and say this
First
is the
move,
dumbest statement.
typically
Remember,
the wrong
the Fed
one,
raised
folks.
by
Remember
50.
that.
Remember,
I'm curious.
The Fed is going to $95 billion.
Are they talking about
in
this
runoff.
wick, or are they talking about
lose
this
sight
wick?
of the-
One of
the-
these
the
wicks are going to be
trees here, or the forest
horrifically
here
wrong.
for the trees. I think the story here is whether or not the Fed
If
is
it pushes
getting
417.75
behind this
again, I
idea
think
of
we're
all
coming
of
down.
those 50s en route there, and whether or not there's some play up and some play down here in terms of the amount.
Stick around, Stephen. We're going to bring back our panel, plus Bob Pisani and Rick Santelli also joining us. Rick Santelli, let's turn to you. What are you seeing in the bond market?
You know, it's
Good old
unbelievably
Rick.
trim and quiet considering. Now, it's a lot of price volatility and yields moving, but just consider, we're at 279. That's where the market was right before Steve Leisman started to read what the Fed was going to embark on. So basically, it's unchanged. And it definitely some stochastic process going on there. 297 was where 10s were exactly before Steve started to read the statement. That's pretty much where they are now. The yield curve, 10s to 2s, was separated by about 19.5 basis points, exactly where it's at now. So what I think is the aggressive tendencies of the Fed have to be embedded in the
volatility
marketplace
coming down. You have
because the Fed isn't gonna back
UVXY
down.
dying.
They're basically putting a block on their shoulder and say, knock it off. Inflation, we're going to deal with you. We're going to squash inflation. So they have to have that unified front. But in reality, the market's pricing in my estimation, worst case scenarios that most likely aren't going to happen. Now, do I think the Fed isn't going to embark on a big tightening cycle? Of course I do. But I just think that going back to
Bitcoin kind of unmoved right now.
Perfect example.
Volatility is still dying as we're seeing the SPY and the Qs pop.
Was tightening. And the markets, the same markets we're quoting now, we're showing 3 more.
Very curious if this will hold. I don't think we're out of the woods quite yet.
So I'm just saying that we need to slay inflation. You need to have a unified front of being tough, but you can't back down at all, even though deep inside, I do think the Fed understands that inflation, at least caused by supply chain issues, is going to moderate. The problem is there's lots of inflation that isn't, like labor inflation. Right now we say, you know, you're not getting paid as much as inflation's going up. But my guess is in 2 or 3 years, that's going to reverse a bit. We're going to see higher wages stay, and we're going to see some of the inflation levels actually dip below that. I think the Fed's doing as good a job as possible, considering they waited too long.
First move is the wrong one, folks. Don't forget. Looking a little heavy.
At the equity market to Bob Pisani. Stocks
looking a little
rather cheered, it would seem, Bob.
I don't know about that, Bobo.
Very muted. Same thing
Bobo,
with the equity
coming
market as
around.
the bond market. We were moving actually before the Fed announcement, a couple minutes before 41.86. And then right after that, we were moving up and moved to 42.10. We're right around the 4,200 level right now, so fairly muted reaction. I think the issue for everybody down here is, has the market priced in enough Fed hawkishness. We're talking about 3% Fed funds at the end of the year. Powell has implied he wants a soft landing. The stock market doesn't believe that he's going to be able to deliver on that. That's the big problem. So can you do a soft landing or not? And the problem is at the meeting, I think you're going to find out, or at the presser, you're going to find out he can't imply that they're not going to be even more aggressive. He can't take 75 basis points off the table. And if he doesn't, that's going to imply an even harder landing. So it's hard to argue for a soft landing when the Fed isn't going to stop with the aggressiveness overall. I can tell you one thing. There is a very bullish opinion being pushed that inflation is peaking. That's going to cause the Fed to back off later in the year. Powell himself addressed this
Give me my money. Give me my money.
Maybe the peak will be in March.
Come
but we
on,
don't know that,
Babo.
and so we can't count on it. So Powell himself has told the bulls, don't expect us
so
to back off.
you guys told me to go
just
short
because
at
you see
first. I did that,
inflation
and
peaking in
then
March,
I always
and
think the
that's
first
what's gonna
move's
keep
the wrong one.
markets
So I
on
went
edge
short
for a
again
while.
at
All right, Mona, let's
204,
turn to you for
and I'm
some
looking to
reaction
try to
and
get
analysis here.
$1,000.
Takeaways?
Yeah, absolutely.
Just
You
give
know,
me
I
my
think
fill.
generally
Come on, give me my
what Rick
fill.
had mentioned is right. I think the markets have priced in a very aggressive Fed. What we may hear from them today is no explicit dovishness. It does not make sense for
Let's
them to
go.
be dovish
Tap
when
it home.
inflation has
Just give me my
not yet
money.
moved.
Give me my money. Got to pay them
if they're
bills.
asked about a 75 basis point rate hike or an intra-meeting rate hike, and they don't explicitly endorse it,
Coming
the
back
market
around.
may take
Wrong
that
way.
as on the margin,
Bouncing off
a
of
slightly
70.
dovish
I had mine
reaction
at
as well.
just
So
above
I think
65.
they will put their foot on the pedal, but they may not explicitly endorse some of the most aggressive forms of tightening. And I think that's what we'll be watching for to see what their path is going forward and how the markets may react to it.
Jim Karen, same question to you. What were the big surprises for you here?
Well, I think that the Fed will likely continue to be very, very hawkish, but it seems that the initial statement wasn't overly hawkish. So I think
that's what they've done every single time. And then they're like, "Hey, don't forget we're going to be super hawkish."
That we have to respect the initial conditions. The the economy has been strong, and we're coming from a very, very strong footing. The equity markets, for example, have been very, very strong. Now, clearly they've weakened, but we're coming from a very, very strong place. So what it seems to me like is that the markets are still a bit unafraid of the Fed. Now, the only issue that I have with that is that if the Fed wants to use their financial
Jerome Powell will be speaking in 20 minutes, just so everyone knows. 20 minutes, Jerome Powell will be
that's
speaking.
What their policy is designed to do. I would argue that the markets probably have to go through a little bit more pain before the Fed actually achieves its goal of pushing inflation to the levels that it wants to, and that they're confident that will actually get to that target inflation point. And I don't see that quite yet, so I'm still a little bit nervous about the markets going forward. Today, right now, might be okay, but going down the road, I'm a little bit concerned.
David, why don't you react to what Jim just said? Are the markets insufficiently afraid of the Fed? I think that was one of the takeaways I took there.
Insufficiently afraid.
No, I think the markets are probably getting this about right. I think the Fed is fundamentally dovish by its nature. They've been squawking like hawks over the last year because inflation's been high. But the reality is, as the economy moves forward through the end of this year into next year, it's going to slow, inflation's going to roll over, and the Fed doesn't want to make the typical mistake of waiting too long and then doing too much and putting the economy into recession. And I think that, Jay Powell at this press conference is going to be asked a lot of questions along the lines of, are you afraid of tipping the economy into recession? I think he's got to reassure people both that we're pretty confident inflation will come down, and no, we're not.
It blows my mind that anyone's buying this. There's no way this could be good. Nothing in my mind.
Steve, let me turn back to you. And
I'm not
we
a
talked
financial
a good
advisor.
bit about the interest rate
this
question.
is just
Let's
not a
talk
good
about
scenario.
the balance
Who would be
sheet
buying
and the
right
pace
now
at which it
for
may
this stock market?
decline? $9 trillion right now. It's going to start at about $47 billion a month, if I'm reading right, between treasuries and mortgage backs, and rise to $95 billion. Why didn't the Fed go there sooner? That was a way to get into this tightening a little quicker.
Why didn't it go to $95 billion?
Well, no. Why didn't it begin? Why didn't it begin squeezing the balance sheet sooner? That's number one. And what do you make of the pace that it is embarking on now?
So I think that the Fed not going sooner is one of the biggest mistakes the Fed has made, maybe since I've been covering them. I mean, they all sort of felt like they ought to have.
No. Whipsaw.
They were doing
whipsaw.
so, Tyler,
Whipsaw.
Yes. A time which was the same month that they reversed course. They had a plan to do something, and they wanted to be, I guess the only excuse you could give is they wanted to follow through with their plan to do something through March. They did so, and then they reversed course almost automatically. It's part of the reason they have to be a little more firm now in terms of raising rates, probably why they're doing 50s now. They probably should have stopped. Powell made a pivot a little bit late, not crazy late in November. You could argue maybe he should have done it in September, but you could say he still had a COVID crisis to deal with back. If you remember, there was another outbreak. Okay, so he was a little late in the rhetorical pivot, but he was much too late in terms of the pivot when it came to buying or stopping the purchase of assets in QE. Let me just say real quickly, Tyler, when all is said and done, I hate to do something too quickly after a statement comes out. We're now, 11 minutes after liftoff here, and I see very little change here in the Fed funds futures market outlook. I'm still seeing them price in 450 basis point rate hikes through September, which means you get to that sort of nebulous neutral rate of 2.25, 2.5 by the September meeting. There's maybe something less of a chance of a 75 basis point rate hike built in, maybe a little bit that came off the boil, but not entirely. It's still 35% for June or July. So I happen to think that this is exactly what Powell wanted. He set the market up for this report or these actions. He gave it to them, and the market at the moment seems to be kind of even and flat on getting exactly what Powell told us we were going to get.
On that note, Rick Santelli, a final thought from you here. The 10-year, which initially dropped about 5 basis points on the statement, is a little bit higher again. I mean, 297, 298, that range. What are you watching?
I am watching the 2s to 10 spread. It's just the easiest way to kind of handicap what's going on the shorter maturities that have been more aggressive in their rate increases because they're more closely tied to the Fed overnight rate. And the long end, of course, has a variety of issues. Investors like to buy higher yielding instruments, even if they're not necessarily in positive real rate territory. And, of course, we have this notion that the long end is going to be our canary in the coal mine, so to speak, on whether the recession, which is caused by inflation and bad policies and mistakes, not by raising rates, which is actually the medicine. And I think that by watching that, if we get around zero, that's not going to be a very good thing. And if we see a bit of steepening, I think that would be a better thing.
All right. There's the 2s-10 spread, just under 20 basis points. And big thanks to our panel, everybody. We really appreciate your thoughts, your reaction, your analysis this hour. Mona, Jim, Rick, Bob, and David Kelly, and, of course, our Steve Leisman. You don't see him in the picture there because he's going over to ask some questions to Jay Powell at 2:30 when the press conference starts. Coming up here, we have more analysis and reaction to the decision from a former governor who's been critical of the central bank, plus Ed Yardeni on the potential still for a soft landing for markets and the economy. We're just moments away from this market-moving press conference with
soft landing my ass. All right, here's what the dealio is. Basically, everyone was expecting a 0.5% interest rate increase. Before this, we were already at 0.25. They just hit us with a 0.5. So in totality, we're now at 0.75. But what was literally just announced was, yes, we're getting that 0.5 that everyone was pricing in. And in terms of looking to the future, all of the meetings, the next 4 meetings that will happen between now and September, that's what the futures market is still pricing in. Each one of those individually being a 0.5% interest rate increase. Now, that's good to know, blah, blah, blah. But more interesting is their concept of a soft landing. Are they going to be able to be like Sully on the Hudson? Will they be able to pull it off? And when I say pull it off and they and blah, 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 what am I talking about? I'm talking about the Fed, and I'm talking about the $9 trillion that they have put into the system basically to get us through the Rona period. Well, that can't just like sit there. That's not how stuff really works. They have to take care of it. And what you do, it's referred to as balance sheet normalization. It's referred to as a balance sheet runoff. Basically, you got to let things mature and fall off of your balance sheet, or you have to actively sell them. So beginning on June 1st, they have mortgage-backed securities and some corporate debt and that type of stuff, and they also have treasuries. So from June, July, and August, those 3 months, starting on June 1st, June, July, August, they will be selling. The cap will initially be $30 billion per month, and after 3 months, it will increase to $60 billion. And in terms of agency debt and mortgage-backed securities, it will initially be 17.5, and then they will increase it to 35. So June, July, and August, it's going to be $47.5 billion worth of selling per month, and then starting in September, it will get notched up to $95 billion. So the way the market has run like an absolute madman, if this ever loads, load or faster. Sorry, I'm just being impatient. All right, let me clear all this up. So this run here, remember when Rona was announced? Rona was announced, no one knew what was going on, and we fell off. February 20th of 2020, and then all of a sudden, you know what happened here? Do you know what the difference was at the end of March? The Fed stepped in and said, we are going to unleash one of the most insane, ridiculous policies of unlimited quantitative easing that this world has ever seen. So this is what happened when the announcement of the Rona and the world's getting shut down and travel was shut down between the US and Europe. It was crazy. And then the Fed right in here said, hey, you know what we're going to announce next week? We're going to do quantitative easing, a crazy policy of quantitative easing. So they started injecting money into the whole system, which served as a backdrop, and it just shoved everything higher and higher and higher. And people who were into higher risk, higher reward things like big tech and all that good stuff, it just kept pushing it higher. Well, as you can see, this obviously changed on January 4th. Do you know what was announced on January 5th when we got the meeting minutes from the Fed? On this day, the day that was the second one after the peak, if you zoom in on January 5th, remember, we're talking about this full run. They announced QE here. It runs all the way up. And then on the 5th, we got meeting notes from the Fed that said they were now looking into balance sheet normalization, balance sheet runoff, aka quantitative tightening. We went from quantitative easing to quantitative tightening. And ever since then, we've been in a downtrend. Now, am I calling for D-Day? Absolutely not. Am I calling for a market to sell off? Yeah, it would be crazy not to call for that. They're about to sell $95 billion worth of funny stuff every single month. You talking about just buying and selling aggression, we're about to run into a wall of selling. Now, with that, I'm never ever going to be calling for like a D-Day type of a scenario, because you can make money in any environment. It's just, do you know the trend? If things are trending up and you're being supported by the Fed or just some bullish tailwinds, that's great. You go bullish. But if that's not happening and you're getting hurt by the Fed, remember, like, you don't fight the Fed. If the Fed's working against you and you're running into some very serious headwinds, well, you make money going the other way. You can make money with the market going up, down, or sideways. It doesn't matter. The name of the game is identifying the trend. I wholeheartedly believe, in terms of the economy and also in terms of the stock market, we're about to be in for a pretty rough patch between now and the end of 2023. Who am I to say this? I don't know. No one. I'm nobody. I didn't study economics. I didn't work at some fancy hedge fund. These are just my own dipshit opinions. So do your own DD. Folks, I do not have the credentials. I don't have the credentials. I'm just saying, studying how this stuff has played out in the past, because I fortunately was hooked on phonics as a child. I do have the ability to read. Filled. Hey, I just made my 1,000. Let's check in on that. Look at that. Snagged it. Short there, locked in my 1,000. We're clawing back our losses from the margin call earlier today. Slowly but surely, they are getting clawed back. Anyway, what was I saying? I have no credentials, but I was hooked on phonics as a child. I have the ability to read, and I also have the ability to see obvious trends in the market. If things are ripping up, you look into why. The Fed was buying everything. Now, starting on January, we started downtrending. Ask yourself, what changed? The Fed said we're going to start selling things. It's pretty basic. This doesn't take some big brain, PhD, economist, master expert trader really to piece together. We're running into $95 billion worth of selling per month. That is a lot of headwinds. I don't think, at least We're going to be in for a bearish red period. That's my bias until inflation actually gets under control. Right now, we're still at a 4-decade high level of inflation. I'm not the one who got us into this situation. Don't get pissed at the messenger. That's just what we're dealing with. I think in the short term, the next year and a half, there's going to be some rough times in terms of the market ahead. If you're on the right side of that, you'll be making a shitload of money. If you decide that, no, I'm going to still continue in trusting in the Fed who told us this was transitory, not worrying about it. If you choose to still trust in the government who says they have it under control and not to worry at all, and they are just going to blame, what was it? At first they were blaming greedy corporations. Now they're blaming Putin. If you want to trust in them, have at it. But my trust is not in the Fed. It is not in the government, because if you do it, it's just simply a money losing strategy. That's my opinion. Do what you want. I don't care. I'm telling you what I'm doing. That doesn't make me right. I mean, this morning I already lost money. Yesterday I lost money. I'm not saying you should copy me. In fact, it's probably crazy to copy me. I'm just simply sharing my opinion and what I'm doing in the scenario. All right, what else do we have rocking? What are you using to short the SPY? The futures market, the S&P 500 futures contract. It's just heavily leveraged, and I just like the way it makes me feel. I like the heightened emotion of big wins and big losses, which probably tells you something about my strange psychological makeup, but I don't know. It's for the content. I know you guys like it. You guys like the good stuff. Let's do it. I'll let you guys trade. We'll go for $100. Next, $100. AKA 2 points. Oh, shoot. That was meant to be a poll. Hang on. Let me make it a poll. Red. Green. All right. You have, I don't know, a couple minutes to answer. A couple minutes. And on Rumble, you could just comment it. On Rumble, just comment up or down. This is how we play the game. It's all chaos. It's welcome to the Thunderdome. Welcome to potentially the start of a recession, he says with a glimmer in his eyes. Short whatever Kramer is pumping. Probably a solid strategy. Probably a solid strategy. All right. Votes are coming in dominantly red. Dominantly red, which means, let me get it set up. La-di-da.
Order filled.
Order filled. Order filled. All right. It's filled. We're in. If it comes down, we'll make money. I did it. I put in the profit target. I'm not going to be messing with it until it hits, but I've learned to trust in you folks. How does this affect AMC? I would say in general, if the market sells off, some people think that AMC will go up if the market crashes. I am not one of those people. I think people are really, really misinterpreting what a negative beta value means. And you only get a negative beta on AMC if you're using a very, very specific time frame. Like I said, this negative beta concept, I think the people who are subscribing to that concept don't fully understand what it is. It's going to be tough for really any equity to perform if the market is crashing. It's just, that's a cold, hard truth. You're going to want to look for, people go to safe haven investments such as gold, or right now you're seeing real estate pop. We talked a lot about real estate. Well, not a lot, but we talked about real estate this morning. There's certain alternatives that people enjoy. It's just, I think some of the things that will get hit the hardest are going to be these high growth tech stocks. Is Apple a hedge? No, Apple has almost a beta of 1. I mean, Apple will be tied very closely to the S&P 500. The thing that moves inverse to the overall market, if you're just looking for a basic thing, is volatility. So if you think there's going to be an abrupt sell-off, you would be looking at something that's based on the VIX. So VXX, UVXY, that will have an inverse relationship. You could also... real estate money could very well be going into real estate. You could be looking at like commodity ETFs such as like gold, silver, like that type of thing. There's various ways to do it. Like there's not like one perfect thing, but people, like I said, they go for safe haven investments. Safe haven investments. All right. We have about 2 minutes. 2 minutes. You guys voted red. You better not lead me astray. Meant if Apple is a safe haven. Apple's not a safe haven. Apple's a leading tech play. Safe havens are like literally like gold. It's gold. Some people would argue Bitcoin, but Bitcoin is now at like one of the highest correlation marks with the NASDAQ. Is this live? That's probably going to DMCA me. Don't do it to me, Fed. They got me. In their own music. That elevator music always takes me down. Whoa, wrong way, Spy. Are you guys sure about this whole red guess? This is getting out of hand very, very rapidly. You guys, how confident are you? And also, what I just showed you is proof that TradeStation did not stop trading. I'm literally trading on TradeStation. All right, Jerome Powell, give us some wow, this is some craziness right here. Look at this. Well, would you look at that? No one has a clue what's going on. That's what makes it fun. That's what makes it fun. All right, Powell, we are looking at a minute out if he's on time. He's usually more on time than President Joe Biden. But to be fair, President Joe Biden was only like a minute late this morning. So we can't count that one against him. Whoa, we got some volume pops, man. Buckle up, Buttercup. Market go brrr. Isn't it just coming right back down? All right, Fed, let's do this thing. What's CNBC up to? We don't need that. We have our own stream of it. You gonna do it? We starting? Alternate player. Here we go. Let's rock. Is he gonna come on? Oh, Jerome. It's your time to shine. This is a bigger player, so we'll use this one. Jerome. Hello. Mr. Jerome. It tanks right before he comes on. Bada bing, bada boom. 250 in the bank.
First time in a couple of years.
In the bank.
Before I go into the details of today's meeting, I'd like to take this opportunity.
Let's do it again. Let's vote again. Next 2 points. Next
Inflation
2 points.
Is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions.
You guys are voting
after
down.
briefly reviewing economic developments.
Order
After expanding
filled.
at a robust
All right, we're down.
5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carried little
58%
signal
down.
for future
We're
growth.
short again. Except
Indeed,
we're going
household
for more than
spending
2
and business
points. I broke
fixed
the rules
investment
of the game.
continued
We're
to
going for
expand
$1,000.
briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be
only
in
to the
store.
Fed.
We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here we go. Here's the real show. Oh, look at those hands. These suits aren't messing around today.
Nick Chamarosa, the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right, 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the beverage curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible?
Spicy.
And perhaps you could walk us through your
testing
calibration.
the trend line.
Why 1 month one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But again, our expectation is if we see what we expect to see, then we would have 50 basis point increases on the table at the next two meetings.
Next two meetings.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for
market
an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You know, you're going to raise rates and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point, was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market, where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks then, but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chain, in supply chains healing. And so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks that have hit really in the last, 60 days, 90 days.
Victoria.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2-to-1 job vacancies to unemployed people. There's a lot of excess demand there. More than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation.
Market still popping.
I mean, we have to be sure that inflation expectations remain anchored, and that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. So two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance. And that depends not only on the level of those things, it depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress. But we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, What is your message to the American people about when they will start to feel the effects of, say, a 50 basis
Still
point rate
going.
hikes or multiple
Jesus.
hikes? How do you explain to them what that does
Wow.
to their grocery bill or their rent or their gas bill? Thank you.
So, the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner the better.
Wild.
Thank you, Chair Powell. Edward Lawrence with the Fox
Just
Business
fight it
Network.
then, dude.
So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has
still
been
pumping.
supported enough from policies at the White House and in Congress
This is
in
just
combating
crazy.
inflation?
You know, it's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given. We don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job to given all the factors that are happening, to try to sustain maximum employment and price stability. So, if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that, stick in our lane.
Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise.
His name tag says Robert Matthews. Is this a case of stolen identity?
Of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. Wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. But I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles, and it was racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. This is we have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side, and we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber at Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point?
That's a good question.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. The point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Seems like you're hesitating, bro.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
Fuck yeah, they are.
So why June 1? It was
Obviously.
just pick a date, and that happened to be the date that we picked. It was nothing magic about it. It's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I mean, I would just stress how uncertain the effect is of shrinking the balance sheet. We run these models, and everyone does in this field, and make estimates of what will be the how do you measure, a certain quantum of balance sheet shrinkage compared to quantitative easing. And these are very uncertain. I really can't be any clearer. There won't be any clearer. People estimate that that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes. I want to remind us, really, that that's who we work for, and that it's inflation that people are feeling all over the country. And it's very important that they know, that we know, how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that. And so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't.
Fuck you.
A good example of why would be that. So
yes, you do.
In the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, very appropriately. Not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions. really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already, and so that shows that the markets think that our forward guidance is credible, and I think that's we want to keep it that way.
I guess they don't have Twitter accounts. This is a guy from Yahoo.
Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works.
Holy
but
shit!
Ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean,
look at this
yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
If this can hurdle 426, we're talking 430.
I was wondering if you could take a step back and talk about, in March,
the Fed pump
had steady, looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that?
Yeah, this is real aggressive, bro.
So look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually month by month, inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got three or four really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year. But that hadn't happened yet. Anyway, we got an ECI reading,
Bitcoin
Employment Compensation Index reading the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing. And it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for white workers.
So
let's bring race
unemployment
into
rates
it,
for all
folks.
racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So so that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion too. That's the good thing, is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
That is it. That's all she wrote, folks. That is all she wrote. Crazy, 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 crazy. This event has now ended. No, you're gonna DM Sammy. Shut up, shut up, shut up, shut up, shut up. Okay, cool. That music, they get you, man. They freaking get you. All right. You guys have two options right about now. You have two options. We can end this and be done, or we can now watch Amber Heard testify. It is up to you, but she just took the stand like an hour or two ago. Things are pumping. I don't know what breakdown you want me to give. Powell basically said, hey, things aren't bad, and they're going to pump it, and no way does this last. Things are bad, but in the meantime, things are pumping. Heard. All right. Everyone wants Amber Heard.
From Adderall and cocaine Johnny, which is very different from Quaaludes Johnny. But I had to get good at paying attention to the different versions of him. 2012, I was in
Quaaludes
the
Johnny.
beginning stages of this, just learning these patterns. I was just learning that drinking kind of correlated with the violence.
And did you confide in anyone about these issues you were having? I think she
Objection,
can say
hearsay.
I think she can say if she told anybody.
As long as she doesn't say what she said.
Right, right. So did you tell anyone?
Yes, I did.
Who did you tell?
I told my therapist. I told
Hearsay.
my mom.
And let's go ahead and take a look at Defendant's Exhibit 150.
Hearsay.
150.
Your Honor, I'm going to object on hearsay.
Called it. I'm a lawyer. Did they pause me? Did they murk me? I objected on hearsay. I know my shit. Volume super low. They lowered the volume. They cut the volume as they're arguing about hearsay. That wasn't me, folks. I didn't cut it on you. I had your back. They cut it on all of us. Love this. Come on. Give us the juicy stuff. They're going to have to fight it out about hearsay. I don't actually know what hearsay is. What is hearsay? Legal hearsay. What is an example of hearsay? The court must hear from the person themselves to consider it as evidence. For example, if you are a witness in a trial, you cannot give the following evidence. My mother told me she was accused at 3 p.m. This is evidence of a statement made out of court and is hearsay. So basically, it's if someone else says evidence and you're repeating it. They don't want to middleman it. Hearsay evidence is a legal form, is testimony from under oath who is reciting an out-of-court statement, the content of which is being offered to provide the truth of the matter asserted. In most courts, hearsay evidence is inadmissible unless an exception to the hearsay rule applies. I don't know what she said, actually. What is she drinking? What is that? What's the purple drink? We need it. Is it Gatorade? Is she sponsored by Gatorade? Come on. Hurry it up. I demand hearsay. Objection, hearsay. What's this camera guy doing? Oh, this is hilarious. Check this out. As soon as this trial started, this is the Google trend for hearsay. Everyone's like, all right, no, like we seriously need to know. 2004 to present. No one has ever cared about hearsay as much as now. Ever. Ever. They're just like, do you think they invested in hearsay before this?
Why
Oh, we're back.
did you decide to confide in your mother about the issues you were having with Mr. Depp?
I think I felt safe talking to my mom because I knew that she understood these dynamics and she wouldn't judge me for staying with him.
For shitting on his bed.
Even though this was happening and was happening to me, I knew she would understand.
And when approximately did you start confiding in your mom about your issues with Mr. Depp and physical abuse?
Objection, hearsay, compound.
Yes, hearsay compound.
When did you start confiding in your mother about the abuse you were suffering at the hands of Mr. Depp?
I was confiding in her from the very beginning about the abuse, the psychological abuse, the kind of control, the disappearing, the not knowing where he was, then he'd come back and sometimes in the middle of the night, the constant accusations, like that sort of thing. I talked to her about probably from the very beginning.
Shut up, Fuzzy.
The fact that I was secret, I had to hide. I couldn't tell any of my friends that I was with him for a long time because he told me everyone would blame me for the split with him and his partner. So I had to kind of sneak around and kind of get brought to his house, typically in a secretive way, and then he'd come to mine in a secretive way, and it was just all very
secret.
So very
Super
isolating.
secret.
And I confided with her at the very beginning on that sort of thing, and then later opened up to her about some of the violence. I did it gently. First I just wanted to have someone to talk to about how scary it was. the rage and the uncontrolled violence, the rage that this man had, and why it was
Objection,
pointed
Your
at
Honor.
me.
Hearsay. May we approach, please?
That was hearsay. The video volume. I mean, folks, I have it maxed. This is fully maxed. I don't know. Buy a bigger speaker. The market is still rocking. It's going to get embarrassing for everyone when this gets freaking rugged.
Ladies and gentlemen, we're going to go ahead and take our 15-minute afternoon break, so please do not talk about the case or do any outside research. Okay, we'll see you soon.
No outside research. You're not allowed to Google hearsay anymore. Well, well, well. Best. Well, well, well. They're laughing because they know it's dominating.
Nothing simple in this case. Over is 2 months before.
Why is all this volume?
Correct.
The document that you signed as part of your divorce proceedings, correct?
That's my signature indeed, yeah.
That is your signature on the right, correct?
Yes, it is.
This is the document you signed, right?
For the third time, that is my signature, yes.
And that was a document you signed in August of 2016, correct?
Is that the same one that I signed 3 times before? Yes, that's the fourth.
I wanted to make clear that you signed that in the summer to Paul Bettany, correct?
Again.
Okay. So Exhibit 500, please. 500? 500. Defense Exhibit 500.
Yes, I'd like to see who I lied to.
Sometimes drink whiskey in the mornings too, right?
Isn't happy hour any time?
Carry cocaine in that box?
No, but it looks like it would fit some cocaine. I once gave Marilyn Manson a pill so that he would stop talking so much.
Is that right?
You did.
Did I read that correctly?
You did.
Okay. Did I read that right?
Yes, you did.
Did I read that right?
You continue to read them right, yes.
Right after you cut your finger off, right after, I won't give you anything to argue with me yet. Right after you sustained an injury to your finger, right after you sustained an injury to your finger,
bless you,
poured yourself a mega pint of red
A
wine.
mega pint.
A mega pint.
A mega pint.
Yeah. Fast forward in time a little bit, Mr. Depp.
It's like a pint, but mega. It's different.
I have other uses for your throat which do not include injury. I have other uses for your throat which do not include injury.
Sorry, could you read that again?
You were drinking.
Were you there? Very ugly situation with Amber. So
Mr. Depp, with respect, trying to respect the court's time and the jury's time, that was not my question. My question was
I
simply,
understand. When
you
you
would
take
agree,
5 minutes to look for a
you would agree,
document.
you would agree that objection calls for hearsay.
It does
Let me
call
ask
for
you a
hearsay.
different question, Mr. Depp.
Yes. Let's let him object to another one. Had a conversation with Ms. Heard.
let's move beyond the conversation.
Well,
Disturbing.
it looks like YouTube's murking me, folks. Probably song issues.
Maybe they're hearsay.
I don't know.
I can read it out of
It happens.
someone's article.
Happens to the best of them.
Not from the man's
I guess
mouth.
that's just like. Well, also now the video's over. Maybe are they gonna let me come back? Are they gonna? Holy shit! This is still going. How am I not margin called yet? I'm about to be margin called. Jesus Louises. This is brutal, team. This is brutal. This market is insane. I think just the shorts are getting squeezed out right now. This is ridiculous. Absolutely ridiculous. Insane, insane, insane. Hearsay. Hearsay, hearsay, hearsay. Wow, 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 wow. This market is absolutely bonkers. Bonkers, bonkers, bonkers. Truly ridiculous. I mean, it can't last. It's just in the meantime, the people betting against it are getting absolutely steamrolled. Absolutely steamrolled. Everything's green. Everything's just ripping right now. Everything's ripping. And it's still going for. I mean, at this point, I honestly feel like the next reasonable resistance level is 430. Wow. Wow, wow, wow. Well, we learned a valuable lesson. This is why you don't fight the Fed. I will have a Fed wrap-up video for you, kind of just like a little short video explaining what they did today. And I'll post that when the market's actually closed to see how ridiculous the market gets today. So that'll be posted later on. We're going to have content here. Crypto Kohrs, if you're on Rumble, you're already good to go. If you haven't already, don't forget to hit that subscribe button. Also on your way out, don't forget to hit that like button. And if you want a Fed breakdown, more of like kind of when you come here, what today's Fed announcement means for the stock inflation and you,